Of course, most businesses track their profit margin, but if you're only watching one number, that number can point you in completely the wrong direction. So here's why and what to look at instead. Profit margin is the percentage of revenue your business keeps as profit after paying expenses. The formula is simple: divide profit by revenue and multiply it by 100. So if you make 50,000 profit on 500,000 revenue, your margin is 10%. Now, there's one thing to clear up immediately. Margin is not markup. Markup is the percentage you add above cost to set a price. Margin is the percentage of the selling price you actually keep. The same transaction produces two different numbers depending on which you calculate. Mixing them up leads to mispriced products and misread performance. Margin is always the right lens for measuring profitability. So then here's where most people go wrong. Profit margin isn't one metric, it's three, and each one answers a different question. Take a business with £500,000 in revenue. Start with gross margin. Subtract the direct costs of delivering your product or service, what's called costs of goods sold. Say those costs are £250,000. That leaves £250,000 gross profit, or a 50% gross margin. That tells you whether your product is viable. If gross margin is weak, your pricing or your production costs are the problem. Next, operating margin. Subtract your operating costs, things like rent, salaries, utilities, software. Let's say those come to £150,000. Operating profit is now £100,000, a 20% operating margin. This tells you how efficiently you run the business day to day. A strong gross margin with a weak operating margin means your overhead is eating into your profit. Finally, net margin. Subtract interest and tax. Say that's £30,000. Net profit is £70,000, a 14% net margin. This is what the business actually keeps, called the bottom line. There's three layers, three different diagnostics, and you need all three to understand where the money is going. So the rule is this: read the three margins in sequence, top to bottom. If gross margin is strong, but net margin is weak, the problem is not your pricing, it's your costs or overhead. You'd be wrong to cut prices to fix a cost problem. If gross margin itself is weak, that's a different issue. That means your product economics need attention before anything else. Now, there is one important caveat. High margin doesn't mean the business is healthy. Margin doesn't tell you about cash flow, debt levels, or what the business needs to reinvest to keep going. A business can show a strong net margin and still run into serious trouble if cash is tied up or debt is high. So the practical action is to calculate all three margins before drawing any conclusions about where money is being lost. Gross first, then operating, then net. The gap between them tells you exactly where to look. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.